Hey there, everyone, and welcome to the Final Bar. It's Tuesday, May 28th. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. Today, as we come off this long holiday weekend, we will talk about the market selling off until around 2:33 p.m. Eastern. A nice rally going into the close, bringing the S&P back slightly above 5,300. Overall, though, a lot of the deterioration we've been covering in terms of weaker momentum, weaker breadth, continuing to manifest here. Defensive sectors at times continuing to thrive. We have a great guest today. Tony Zhang of OptionsPlay is going to join us from Australia, giving three stocks that he is watching in this particular environment. With that in mind, let's get to our market recap and see how the charts evolved during the trading day today. Before we bring up a single chart, though, I do want to answer a poll question we had going on our social media platforms just recently. Will the next 10% move in the alphabet, GOOGL, be higher or lower? 69% of you saying 10% higher will come first before 10% lower. Let's go to the Stockcharts ACP, which is a great way of sort of looking at forward-looking ideas. And the reason is because our ACP platform, our advanced charting platform, allows you to do a lot of really cool dynamic charting. So if I want to take something and really break it apart, drag things, move things, put cool annotations on, ACP is a really cool place to do so. So I'm looking at the chart of Alphabet here for about the last year and a half. I have 10% higher, 10% lower, just to show where about that would get us to. 10% higher gets us to around 195. Alphabet closed around 176 today. So about 10% up would take us to just around 195. That, of course, would be a new all-time high because we're there now, right? We're sort of right off of new all-time highs over the last week or so. So 10% move above would really propel Alphabet to much further highs. And if you think about it, how long that might take, right? If that takes a month, that's an aggressive move higher in the month of June. 10% lower would actually take us slightly below the 50-day moving average, take us just around 158, we'll call it. Still most likely above the 200-day moving average, depending on how quickly that sell-off would occur, but would certainly mean a fairly dramatic shift from uptrend to downtrend. Boy, if asked, if I would have to vote, this is a really tough one. And the reason is because 10% is a pretty wide berth on either side of it. I would probably say down rather than up, only because given the deterioration in momentum, given the deterioration in market breadth, certainly feels like the market has to have more of a corrective move, most likely into the summer would be my guess, right? That's what the normal pattern has been. We very rarely had a major market top in May or June. We have often, in the last 5 years, every time we've had a major top in July or August, right? So, looking into that move, do I think Alphabet could get another 10% up before rolling over? Probably not. But that's a tough one. And that thinking, that way of thinking about potential outcomes and how that might impact your portfolio is a set of thinking that I hope you can do on the Stockcharts platform. A lot of great tools to think about potential moves and what they might mean for you. Thanks for answering those poll questions on all your social media accounts. So make sure you follow us anywhere you can. Continuing on here with our market recap, you see on the little 2-day preview chart, there's Friday before the Memorial Day weekend, and then here is Tuesday, the first trading day of the week. You can see that most of the day was basically chopping around Friday's close, so this felt like an unch day all the way until around 2 p.m. Eastern. At that point, the market rolled over, and around 2:30, we ended up making the lows for the day. The last hour, fairly strong, and so you had a lot of buyers coming in the last 30 to 60 minutes, pushing the S&P back above 5,300. So the S&P 500 ended up being essentially unchanged from Friday's close, finishing right around 5,306. The NASDAQ composite really getting it done. It ended up going back down to Friday's close. That served as support. We traded back to the highs of the day, about 0.6% higher to 17,020, we'll call it. The Dow is actually 0.6% lower. It did have a late-stage rally along with everything else, but it was really a deterioration. So, the S&P kind of flat for most of the day. The Dow was actually selling off fairly consistently. The NASDAQ overall having a pretty decent day. So we're back to sort of the NASDAQ up, Dow down, growth-oriented bull market configuration here. Mid caps and small caps in the red as well. The S&P mid cap, the 400 index, was down about 0.7%. That's your worst performer here on our front page. The VIX just slightly below 13. It actually was popping higher through the course of the day. It was well above 13 earlier in the afternoon, but by the close settling back down to just below 13. As we mentioned, the volatility overall I would describe as low, and any VIX reading below 15, any VIX in the low teens, I would say is a low volatility environment, which for me means that's great. That means all is well until and when the VIX starts popping above 15. And while that might not be the end of the world, definitely would tell you something is changing. So I would encourage you to set an alert on our platform for VIX over 15. That's a great thing to monitor just as an initial warning signal that the fear, that the uncertainty is starting to be a little more elevated. We're still not seeing too much of that just yet. Rates overall pushing higher. The 10-year yield, the long bond yield, almost a full percent higher from where we were on Friday. Sorry, that's not a full percent. That's a 0.1%. Excuse me. I'm looking at the quote from the CBOE that's quoted at 10 times the value. So the 10-year yield finished at 4.54. That's about 10 basis points above Friday's close. The long bond yield moving up as well to around 4.66. The 5-year point around 4.59. There was a great article, by the way, in the Wall Street Journal. Might have been over the weekend. It might have been this morning. I forget when I read it. I read a bunch here recently. But the article in the Wall Street Journal is talking about that inverted yield curve and how it really has not been a particularly great indicator of a recession right now. Now, having said that, a lot of times the yield curve is inverted, it uninverts, and then the recession actually is flagged later. So something to keep in mind. It may end up being a very prescient signal, but certainly with the growth we're seeing from economic conditions does not appear to be recession-like at the moment. Bond prices, of course, going lower. The TLT was down about 1.4%. The dollar index, no real change from Friday's close. Commodities almost all in the green today. Gold prices up. The GLD was up 1%, a little slightly higher. Silver prices up 5.5% for the SLV. Well, crude oil prices up. The USO, which is a crude oil ETF, up over 3%. Copper prices, natural gas prices, all in the green. Some of the soft commodities like corn, a little bit weaker, but the precious metals, the energy side of the commodity space, all firmly to the upside, continuing that arguably broad bullish cycle that we've experienced. Friday's show, actually Thursday's show, we talked about that bearish divergence between price and momentum for the GLD. Overall, gold popping back higher today. Cryptocurrencies, the top 10 coins that we track on our platform, almost all in the red. Bitcoin over the long holiday weekend did get above 70,000 again, but rotated right back below there. So 70,000 continues to be a line in the sand, a pivot point, a level that continues to have meaning for Bitcoin. We have been unable to mount any significant foothold above that 70,000 level, and previous attempts here in recent weeks have been repelled. Once again, more of the same here with Bitcoin rotating lower after that push above 70,000. Looking at the 11 S&P 500 sectors, we have energy up 1.1%, technology up about 0.5%, communications services, the XLC, up 0.2%. All the rest, the other 8 S&P sectors, all in the red. Your bottom 3 performers are industrials and healthcare, both down around 1.25%. Financials down 1.1%. Looking at our Keller market model, like the market trend model, as I like to call it, this is using a series of weekly exponential moving averages that I started using a while ago, and now we've adapted into a widget here on our Stockcharts dashboard. The S&P 500, all the major equity averages, all in the green across timeframes. Bonds, all in a bearish trend, long-term, medium-term, short-term, all aiming lower. Had a little bit of a change here as of, I think, on Friday's close, but the commodity space all bullish here again, and the dollar index bearish on the short term. We'll see some of those charts here, time permitting. Looking at the Magnificent Seven, this group of leadership growth names, you can see NVIDIA continuing to push to the long side. Another 7% higher. NVIDIA was arguably one of the key stories last week after earnings. They reported a 10-for-1 stock split coming up next month in June. Reported record earnings. Obviously, AI, a big driver of NVIDIA, continue to push higher. So the SMH making new all-time highs. NVIDIA pushing additional new all-time highs well above 1,000, which was a bit of a ceiling before, now well in the rearview mirror. Now, this is going to be cut by 10% here next month, so we probably won't see these particular levels anytime soon again, but again, the stock continuing to be treated with additional buying power coming in. Most of these growth leadership names in the green today, save Tesla, which continues to lag and drag the consumer discretionary sector further to the downside. Let's look at a daily chart of the S&P 500. As I mentioned, I think on Thursday's show last week, I had a soul-searching moment and really sort of wiped my S&P chart clean. This happens for me. It's like cleaning your garage. I think of charts as a running dialogue, a running conversation you have with the markets as a way of saving your ideas, saving your thoughts. And over time, there's a lot of clutter that gets on there. Starting clean is actually really helpful. It's a nice therapeutic thing. About once a quarter, I do that on my chart of the S&P 500. I don't schedule it. It just sort of happens when I feel like I need it. And as I was just reflecting on the movement in the S&P over the last 6 to 12 months, a couple levels stood out to me. 5250, obviously a key level. That was the resistance. That was that high that we had in March. We tested it a couple times here, late March, early April. We then sold off to just below 5,000. We then bounced back up and 100% retracement back up to those highs. We gapped higher about a week and a half, 2 weeks ago. And from there, that's been it, right? From that gap day, that's literally where we closed today, is almost at the same exact level. So after the S&P gapped higher, we sort of were sideways for that whole time. So the chart of the S&P is not negative, right? I mean, I would say if you ask me, what is this chart? I would say bullish, right? Because we're making higher highs and higher lows. And you can see we have a lot of room to pull back and establish a new higher low before we rotate more to the upside. Key levels to think about, I think 5250 is that tactical level of support. As long as that holds in the next week or two, conditions are still just fine. Even though we're not going up, we're not really going down at all. But the 50-day moving average trend line support, using the major lows for the last 6 months, is all coming in around 5150 to 5200. That's sort of a really key level to think about potentially as well, what we call a confluence of support. Multiple indicators all kind of coming in at a particular level. The real level of support that I think would completely change the face of this market or change the character is 4950. That's your swing low from April. So as long as any pullback makes a higher low above that level, this longer term uptrend is still very much in good shape. We closed below 4950 and all of a sudden we're no longer making higher lows. One of my mentors, Ralph Acampora, would say this is a very negative rotation if we can't make a higher low. But for now, of course, we're nowhere near those levels. We're well above 4950, 350 points above it to be particular. So overall, all appears to still be quite strong here. Let's look at a couple individual charts here to continue our market recap. I do want to mention breadth. We've covered, I think, very widely the deterioration in breadth conditions. One of the things I just wanted to point out as I was writing my note for my market misbehavior premium members over the weekend, what we call our weekly flight plan, looking at some of the key metrics and key macro indicators from a technical perspective, the breadth conditions just continue to underwhelm. If you look at the percent of stocks above their 50-day moving average, when we're breaking above 4,600, that is, back in December into January, we had around 90% of the S&P 500 stocks above their 50-day moving average. When we made the new all-time high above 5,200 for the first time in late March, we were down to around 85% of the S&P, still a pretty healthy number. As we just made a new all-time high above 5,300 for the first time earlier this month in May, we peaked out around 65% of the S&P above their 50-day moving average. So there's your difference, right? As we're making a break above 4,600 back here in December, 9 out of 10 S&P stocks above their 50-day moving average. As we made a new high a couple of weeks ago, we're down to around 65%. So 25% of the S&P basically was in an uptrend back here, but has failed to regain its 50-day moving average. And as of today, we're back below 50%, around 44%. So while the S&P is making new highs, we're back to that AI dominance. We're back to the growth stocks, the mega cap names really propelling things higher. The average stock is not looking particularly strong here as we wrap the month of May and go into June to continue and sort of complete Q2 of 2024. We're through earnings. We have the Fed meeting coming up in 2 weeks. I'm concerned by the breadth that is not supporting this move higher. The momentum on a lot of names is not supporting the move higher. And we have other issues as well. There's this thing called the Hindenburg Omen, and I put a video on my YouTube channel called Market Misbehavior on Friday, so check it out if you missed it. We talked about this Hindenburg Omen. It did give an initial sell signal on at the end of last week. What happens with the Hindenburg Omen, we have an indicator, exclamation point BINYHOD if you want to follow it on your own account, or we'll put a link to a chart like this one in the description or in the comments so you can save it to your own Stockcharts login. But basically, this tracks the 3 parameters within the Hindenburg Omen. When it gets to a positive 3, that means 3 things have happened which are very consistent with major market tops. The last time we had a confirmed signal where we have multiple flashes of that sell signal within 1 month was in the end of 2021 before a major market top. Before that, it was just before the COVID peak or at the COVID peak in February of 2020. To get a confirmed signal, we would have to have another combination, this indicator getting back to +3 within another 3 or 4 trading weeks. We'll put a link again in the description with the chart to follow that. My channel called Market Misbehavior, we're into a little more in depth than we can cover here today on the Hindenburg Omen, the concerning development that we've observed there. Let's finish off talking about some individual names and some individual charts of interest. The energy sector, your top performing sector through the day today. What's interesting is the XLE. Actually, is that true? I think that's true, but now I'm thinking I might have looked a little. No, it was. I was going to say energy. I thought was #1 here. I'm losing it. There we go. So the XLE was up about 1%, but it's still within what I would probably loosely call a bull flag pattern. It's not a perfect one. A bull flag is when you have a big move higher, then you have sort of this counter trend move, lower highs, lower lows. Ideally, it's a really clear channel. I don't know if we really have that anymore, but we have arguably broken out of a bull flag, or we're very close to doing so, which is when we rotate out of that pattern to the upside. And if and when that would occur, I think that could be a really big bullish development for the energy sector. The problem I have with that call at this particular moment is that crude oil prices, while they're up today, have not been particularly strong, right? The USO gapped higher today. It was up about 3%. This is the WTI Cushing as of Friday's close. You can see we're just languishing below that $80 level. The $80 level is the resistance that we've experienced through the month of May. It's also the 200-day moving average, which is sort of a couple of things what we call a confluence of resistance. I think getting above $80 a barrel would be quite bullish, but we haven't quite done it yet. We may do it today because you can see the USO is gapping above and making a new high for the month of May. It did find support at its 200-day moving average. And again, the USO is an ETF that is really derived from the crude oil future that we showed previously. So I'd be looking to see if we can get crude back above $80 a barrel. Could be quite constructive if so. NVIDIA gapping higher, and again, this chart just continues to impress. There's last Thursday with the gap higher after earnings. Friday, another close above 1,000. Today, we're gapping up another 7% as of at the end of the trading day. So when you look at NVIDIA, when you look at semiconductors, it looks very different than a lot of other charts because most charts do not look this incredibly strong at the moment. There are some stocks making new highs, but not a lot of them making new all-time highs today, and that's what you're seeing with NVIDIA continuing to push to the upside. Within the materials sector, I'm encouraged by a chart like FCX, and I forget which guest of mine mentioned this stock recently, so apologies. We could go back to the tape and see who it was, but what's interesting about the chart of FCX, obviously in the materials sector, this is more of a mining name, sort of a non-gold mining stock within the materials sector. You see resistance around 52, which held in April, and then in May we finally broke above it, but we gapped lower last week. Today, it almost suddenly feels like we're starting to find support within this consolidation area and now retesting the previous highs. So I like the action today. I would love to see continued upside because this is a stock that had shown a bearish momentum divergence. That's when you have higher highs in price, lower peaks in momentum. The way that you negate that is you make new highs on stronger momentum, and it tells you that that bearish configuration is not sustained, and we're actually changing it. There are more buying power, more buyers coming into to the market. Today may be the beginning of that, and I like the gap higher and the higher close. Let's see if there's additional upside to be had, pushing the price back to new highs. Enphase Energy, also one of the top performers in the S&P 500. Again, we're looking at 2-year charts just to put today's move into a good long-term context and think about where we're at relative to where we've been. That's one of the reasons why this show is called The Final Bar, because I always tell people, look at the bar, look at the final bar, today's move, and then look to the left and read right to left to see where we're at relative to where we've been. You can see that this stock is making a breakout move above previous resistance around 120. We're now back above moving average resistance. The 200-day moving average had served as resistance heavily for the last quarter, right? February, March, April, May. Look at the number of times we attempted to get above the 200-day moving average but failed to do so. Over the last week, we have finally established what appears to be a pretty good foothold above the 200-day moving average. The RSI is pushing above 60, which is actually quite bullish because that means there's enough upside momentum to push the RSI more into a bullish framework above 60. So I like that move. It would be great if we had a pullback above those moving averages, which would really confirm what I would say is most likely a change of character. and a rotation back to the upside. It's not all great in equity land, and I'll just final chart for our market recap. Ford Motor Company, ticker F. If you're not familiar, completing what I would argue is probably a complex head and shoulders pattern. A head and shoulders is where you have a head, a high surrounded by two lower highs. A complex head and shoulders where you have multiple left and right shoulders. In any case, the neckline, those lows connecting or below the interim highs, is a key level. When you finally break through that neckline, which today's close did, that is a very bearish pattern, suggesting that this is a topping pattern now completed. You generally take the height of that pattern and project that from the lows, which basically gives a minimum downside objective around 1050, suggesting a retest of the lows for 2024. So deterioration continuing to plague Ford, one of the big automakers here in the U.S. That's it for our market recap. We have a great guest today. Tony Zhang of OptionsPlay is going to join us here in a moment. Before we do so, one quick reminder, and that's to contact us with your questions. We so appreciate the feedback you've given us on the show. Thanks for putting lots of comments in here, letting us know what you think of our guests, of me, your host, of all the content, the things that we focus on. We always are looking to do better, but we can really benefit from your questions because thoughtful questions help us have a great mailbag episode where we really address some of the things that you are uncovering as you're using charts. The final bar at stockcharts.com is our email. We're here on YouTube. Again, just drop a comment below the video that you're watching. We'll hope to answer one of your questions in our next mailbag episode. I want to welcome on today's guest, Tony Zhang. Tony's the chief strategist at OptionsPlay, coming to us from Melbourne. Tony, thanks for getting up early and be able to talk to us. How are things these days? How are you navigating these markets, okay?
Things have been great. Thank you so much. It's great to be back here on the final bar. I'd love to talk some charts with you. It's
been too long, Tony. Hopefully we can get a regular cadence of these conversations, but I appreciate you joining us today. As we talked in our market recap, we have the S&P that has pushed above 5250, and now it's been sort of sideways a week and a half. Where's your head at as you sort of digest this sort of sideways, choppy environment? What's your general sense of things?
Yeah, that's a really good question. We broke out above that 5250 to new all-time highs, and it really has lacked any momentum to follow through. You have the VIX back below 12 as of Friday. We're trading just around that 12 handle right now, and a lot of traders would say there's a lack of fear in the markets. I would say there's a little bit of complacency right now from traders as we reach these all-time highs. And I really look back to what Julia said last week on your show. Look at the sectors that are leading this move higher as we made all-time highs. It's the defensive sectors that are doing it, with the exception of technology that has come back to life over the last couple of weeks. But for the most part, you have consumer staples, you have utilities. These are not the type of sectors that you want to see leading the markets higher as we print new all-time highs. You have discretionary, you have materials, you have industrials, all lagging behind even further as we go along. And those are some of the concerns that I have on this a new all-time high that we've seen on the S&P 500. So it looks a little better on the NASDAQ 100, but the Russell 2000 looks quite poor. So overall, we don't have broad participation on this market rally. And for those reasons, I'm a little bit more cautious here on these all-time highs. However, it's hard to fight the bullish trend that markets have been in for the last 6-7 months. So those are some of the things that I am cognizant of as I look for opportunities in this market.
Oh, that's well said, Tony. I was taught the most bullish thing the market can do is go up, and we're getting that, but I feel like underneath the hood, all the concerns you mentioned, well taken. Even real estate at times getting a bid here recently. So defensive sectors starting to thrive a little bit. You shared some ideas with me ahead of time. Let's go through a couple of these charts together if we could. We're starting in the consumer staples sector. Coca-Cola, what's the take here?
Yeah, this is really one of the big names in the consumer staples sector, which is one of the sectors that have been leading this market higher towards those new all-time highs. And as you can see, Coca-Cola just earlier last month broke out above the $61 level that has been the 52-week high for quite some time. And we've broken out above that level now, gotten all the way up to that 60, close to 64, and now we've pulled all the way back to that $61 support level. And I simply think from a risk to reward perspective, it looks favorable to seek some long entry here for Coca-Cola, especially if you look at the valuations here. We're trading about 22 times forward earnings, which is quite reasonable given how strong the margins are for Coca-Cola. Growth rates are somewhat similar to its peers. So the fact that we've got that breakout here, pulled back to that support level, especially when you have a little bit of outperformance relative to the market that accompanies that, I think this is an opportunity where the risk reward is favorable for long exposure here in a name and a sector that has been outperforming this market right now.
It's a great example to talk through, Tony. I appreciate that. With something like this, I know some people have a much easier time sort of buying new high, buying when things are working versus buying weakness and being concerned that you're going to buy into further deterioration. Just generally speaking, how do you manage that sort of downside risk in a name like this? How do you prevent your entry just getting washed over by further downside? How do you think of that?
Yeah, that's a really great question. From my perspective, it really comes down to risk to reward, right? When you wait for the weakness and you wait for the pullback near that support level, you're actually risking less in this particular case, because the closer I entered to that $61 support level, the less risk that I'm actually overall taking on this trade relative to the potential reward. So if I enter here around 61.80, 61.50 or so, if the stock breaks below 61, I would consider my thesis on this trade incorrect and get out of the trade. I might be risking somewhere in the neighborhood of maybe $2 per share before I would say, hey, I've got the thesis wrong. That $61 support level didn't hold. Let me get out of this. Versus if I had chased this high, at that $63 level, it would have to pull back again below that $61 level before I would consider my thesis to be incorrect. So that I'm actually risking more on the trade by trading buying the all-time highs, hoping that it continues to move higher rather than waiting for some weakness. So it really comes down to risk reward, and it's far more favorable to wait for a little bit of weakness, a bit of a pullback here, and buying at a lower price.
Oh, well said. That was a mini masterclass in risk versus reward, Tony. I appreciate that very much. Meta is chart number 2. It's had a nice bounce after a gap lower in April. Is this a bullish setup here? Why, yes or no?
Yeah, so it's hard to fight the momentum that we currently see from the Magnificent Seven tech stocks, and then largely what has been driving the gains that we've seen here in the S&P 500. So Meta had a very strong quarter, but last quarter we saw that stock drop quite a bit, nearly 20% on that move lower here. On the back of how much they were spending on AI going forward, with a lack of clarity in terms of how they were going to make that money back in terms of revenue in the future. But as you can see, the stock has recovered back and has filled that gap just about 2 weeks ago. And we've kind of we're back to retesting that level, that 481 level as resistance now. We haven't broken out just yet, but this is really where I think that there's a potential for that breakout higher here, especially if markets continue to move higher. I feel that technology is likely going to be a sector that will remain strong and continue moving higher as well and continue that leadership. And Meta certainly fits the bill in terms of the type of AI-related stock that will likely be that leader. So the breakout here, if we do get that breakout about 480, I think we can easily target the recent all-time highs just shy of that 530 level, 525 or so. That would be my first target. And I think the upside here is for Meta to continue moving higher. Meta's trading at about 24 times forward earnings, despite the fact that it's got one of the fastest growth rates in terms of EPS for the Magnificent Seven, and continues to have very, very high margins, out of the businesses here. The only thing I think a lot of investors are unsure of right now is really how is it going to make its revenues back from the spend that they have on AI. But I don't think we're necessarily going to get clarity on that in the next few weeks from any of the AI related stocks, but we continue to see NVIDIA earnings show us that enterprise is continuing to spend at a pretty accelerated pace to try to fight for dominance, and Meta, I think, certainly will be a leader in that particular space.
The AI trade appears live and well, but I love this actionable idea just bumping up against a well-trodden resistance level there with Meta. Let's get to more of a negative idea. Kroger is a grocery store name really starting to break down here. What's the outlook on a stock that's been struggling recently?
Yeah, these grocery stocks, these supermarket stocks, they really trade on, they really operate on razor thin margins, and Kroger is no exception to that. Coca-Cola has about 24, 25 net margins. Kroger has about 1 to 2% net margins. So for every $1 they make in revenue, they make about 2 cents, less than 2 cents in terms of net profits, and that's a tough business to be in. And Kroger, had this really strong run earlier this year from that $44 level in early February all the way up to 58. These are not the types of moves you see from these supermarket stocks for the most part, but you had the strong move. After that big move here, we formed a bit of support around that $54, $55 support level. And just last week, or the beginning of last week, we started to see that break below those support levels. And notice how that's accompanied with some underperformance relative to the S&P 500, which confirms the breakdown below that key support level. So when you have negative momentum in a stock that trades at a pretty rich valuation, given how thin the margins are, revenue is expected to grow about 1%, not really exciting, and such thin margins. It's trading at 12 times forward earnings, which is certainly on the high end of the historical average for Kroger. I think that my downside target is to fill that gap, which comes in just a little above $50 at my initial downside target. But I actually think that there's not a lot of support at those levels. If we break below 51, I think we're headed back towards closer to that $46 level, which is the level which we broke out from, 46.5 or so. So that's kind of how I'm looking at Kroger, which is very different as a consumer stock to Coca-Cola because of how thin their margins are.
Oh, really well said. I really appreciate that comparison, compare and contrast between those two different businesses. We just only have about a minute left, Tony, but I'd love to, just answer this question if you could. At the beginning, we talked about sort of the overall environment. The macro sort of stalled out here, the momentum weakening. You're still able to find some individual stock ideas that look pretty strong here. How do you relate the macro to the micro in your work? When you're looking at it, does the macro big picture inform your thinking about individual names, or is it more of a bottom-up process, just looking for opportunities in any environment?
I definitely prefer the opposite, the top-down approach. So the macro view certainly informs my views of whether I'm looking for maybe some more bullish or more bearish opportunities, or which sectors I'm looking at. I certainly take I pay a lot of attention to sector rotation, meaning which sectors are leading, which sectors are lagging behind. But overall, I think you have to consider the overall trend, which is clearly up and to the right. We've made a new all-time high. We have to respect that. Even though I'm a little bit more cautious and I have some downside views here, I'm not just all bullish in this market environment. That's kind of how I'm looking at this, a top-down approach. But the fact that we are making new all-time highs informs my view that I'm going to lean a little bit more towards the bullish side, even though I'm a lot more cautious.
Oh, that's a great point, Tony. And I've always said savvy investors use the charts to really follow how the evidence has evolved, and hopefully some of your comments will help them do so. Tony Zhang of OptionsPlay, thanks for joining us from Melbourne. Have a great day, and we'll talk to you again soon, all right?
Thank you so much, David. Have a great day.
That's Tony Zhang. Tony's the chief strategist at OptionsPlay. And I love just that discussion about sort of the big picture versus the small, the macro versus the micro. And what I love about Tony's discussion about some of those names, if you picked up on it, we talked about each of those three particular stocks. It was about the chart, it was about the levels, it was about the momentum, it was about the trend, it was also about valuations, it was also about what kind of businesses they were and what the opportunities could be. I think he described very well, sort of illustrated that fusion analysis approach of thinking of the technical, the fundamental, the macro, all as one holistic point of view. I really appreciate how he was able to summarize that. Great take from Tony Zhang at OptionsPlay. Folks, we've got to wrap this show, and that's it. Thanks for joining us every weekday after the close for the final bar. Again, a special thank you to Tony Zhang of OptionsPlay joining us from Melbourne. For Stockcharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.